Welcome to all. It's with great pleasure that I open this event organized by ICMA's Irish Regional Committee on the topic of the changing face of ESG finance in the international capital markets. Sustainable finance is one of ICMA's 4 key areas of focus, and sustainability is increasingly integral to everything we do. We are privileged at ICMA to be the stewards of global standards for green, social, sustainability, and sustainability-linked bonds that are referenced by more than 95% of international issuance in these segments. These standards have been developed with the input of a wide market initiative of more than 400 organizations and stakeholders under the auspices of the Executive Committee of the Green and Social Bond Principles supported by ICMA. Most recently, the 6th version of the Green Bond Principles was published last June. This is the first update to the GBP since 2018. With this 2021 edition, the Green Bond Principles integrates best practices that are recognized by a majority of issuers in the market, while also preparing for current and future regulatory developments, especially in the EU, but also in Asia. The 2021 editions of the Social Bond Principles and Sustainability Bond Guidelines have been similarly revised. ICMA is also very engaged in regulatory dialogue on sustainable finance, notably in Europe, where we have been members of all of the European Commission's technical committees, including now the Platform on Sustainable Finance. Generally, our objective is that the market's voice be clearly heard, and we aim to help regulatory and supervisory authorities to fully consider the appropriateness, coherence, and impact of their initiatives on the development of sustainable finance. The international sustainable bond market is in a renewed growth phase, with combined volumes this year reaching $630 billion as of end August, surpassing already last year's total of $589 billion. While the market is on its way to another record year, some even anticipate it could reach the landmark of $1 trillion by end 2021. In this context, it is good to see several sizable transactions coming out of Ireland from bank issuers this year. Overall, Irish issuers have contributed nearly $12 billion to the outstanding market, with the leading role of the NTMA being particularly noteworthy. Coming back to our event, you will see in today's agenda that we have 2 very interesting panels, with the first focusing on the impact of regulation and the second on market practice and its evolution. There are also 2 keynotes, with the first from Paul O'Connor from JP Morgan, with whom I work closely on the GBP Executive Committee, and the second with Mark Whelan from AIB, who is also the esteemed chair of our regional committee. I'm sure that you will all enjoy and learn from this exciting event. And now it's over to you, Paul.
Many thanks, Nick, and good afternoon to everybody. So Paul O'Connor, I look after ESG Debt Capital Markets for JP Morgan EMEA region. So I would like to speak for maybe the next 10 minutes or so, and I will give you an overview of current trends that we're seeing in the ESG debt capital markets. Talk a bit about the Irish context, what Irish issuers are doing or thinking of doing. Talk a little bit about ESG Investor Expectations and how those are evolving over time. Very important area of discussion. And then lastly, a few sort of hints and tips and things to think about if you are contemplating accessing the ESG debt capital markets. Do bear in mind that you can ask questions whilst I'm speaking at any point in time, and I will do my best to get to those towards the end of the session, and hopefully can help out on any points of interest. So in terms of broad introduction, I think Nick has set the scene in terms of the numbers. It's fair to say that we have seen a fairly rapid, dramatic expansion of the ESG debt capital markets since their inception, maybe around sort of a little over 10 years ago. And as Nick says, we're already ahead of where we were last year, and the year is not finished yet, and issuance continues apace. We're expecting, I guess, to land somewhere between maybe $700 or $800 billion of issuance by the end of the year. It is possible, as Nick says, that will actually end up being higher. We do have more labels in the market. We have different structures, and we have different industry sectors coming to market, and that is all adding to supply. So just as an example, we have now the sustainability-linked bond structure, where the issuer commits to achieving a certain ESG-related target and creates an incentive for themselves to hit that target by introducing a penalty mechanism in the bond. So this is all adding supply to the ESG debt capital markets. And in fact, I think sustainability-linked bond issuance is up about 170% over where it was last year. So this is becoming a very popular structure. I did also read recently that we're up to 25% of debt issuance, bond issuance in Europe being issued with an ESG label. So that's quite a dramatic increase over where we were even last year. And just as another example, in terms of investor demand for ESG labeled securities, we had a 100 billion order book yesterday for the UK's inaugural green gilt, which is the sovereign green bond. And that was on a 10 billion bond. So just to give you a sense of the appetite out there on the investor side for securities that have an ESG theme. So I think that brings me to my first point, which is ESG is really being driven at the moment by investor demand. Asset owner preference, people who are becoming aware that the way that their capital is allocated, does have a sort of a real world impact. And all other things being equal, they would like to look for opportunities to allocate capital in a way which creates more sustainable outcomes in the economy more generally. That is really what has been driving issuance to date. Government, I would say, is starting to provide a stronger and stronger tailwind. We have a very ambitious platform in the EU, sustainable finance platform, and that is a strong steer to corporates operating in EU countries as to what the expectations are. We've also seen globally, outside of Europe, governments also taking steps to develop green classification systems and to otherwise try to facilitate the expansion of ESG debt capital markets. But primarily and to date, at the moment, it is ESG investor preference and corporates starting to respond to that preference. I would say that this story is relatively well established on the equity side, and it's only fairly recently that it has really accelerated on the debt or the fixed income side, where it's hard to really tell the difference now between equity and debt investors in terms of the way they look at ESG issues. So very much a sort of a common approach and a common mindset for both debt and equity investors in terms of the way they expect companies that they are investing in to evolve their strategies over time to make sure that they can create a resilient business model which will be fit for purpose in a world where ESG issues are becoming more and more pronounced, and the actions needed to address those are becoming more urgent, I would say. So that's in terms of the broad backdrop. In terms of the Irish context, I think it's interesting. Ireland was, ahead of the game at the sovereign level, and is already an experienced issuer of green bonds, and that's very important as a scene setting. And I think it's fair to say that some of the more important actors in the Irish economy have already issued their own ESG themed bonds. So we've seen ESB coming with a green bond, and obviously Allied Irish Banks and Bank of Ireland have already issued their own green bonds. So very important actors in the economic context overall, and important that the sovereign kind of underpins the messaging by issuing its own debt instrument to communicate what the plan is at government level to sort of support the development of a sustainable economy. So I think Ireland, in summary, has got a great opportunity. A lot of the building blocks of a sustainable economy are already there. And I think it's worth picking up on some specific things like renewable energy. The government has set pretty ambitious targets to decarbonize the Irish energy system more broadly, particularly the electricity production. And Ireland is in a great position to show what can be done by, harnessing natural resources in the form of wind energy, for example. Onshore wind is an established technology, well understood. We are now going offshore. It's a bit more complicated, but there is a great opportunity to, build an understanding of offshore wind technology and harness the opportunities afforded by that technology. I think safe to say that renewable energy and bringing on stream, substantial renewable energy, driving down the cost of that energy, making sure that we take account of grid stability type issues and make that renewable energy available in the Irish economy in increasing proportions is key to decarbonising the economy overall. Clean energy as an input into the economy is a fundamental building block of greening any economy. And so making the most of the renewable energy resources that we have, I think, is going to be important, in establishing a platform for, a clean, green economy over time. So wanted to just highlight that. And obviously, if you have the renewable energy, you have a shot at decarbonising transport. And I see Janice from LeasePlan is involved in this session, and LeasePlan being in a great position to show what can be done through electrification of vehicle transport. And obviously, that is all dependent on everybody being able to access renewable energy in a way which allows them to drive around, without worrying about how far they're going to get. So renewable energy is a key input both on the manufacturing side and also on the transportation side. So there's a couple of other things worth mentioning. Afforestation, I think there is an opportunity to present forests as not only a source of raw materials, but as a sort of a carbon storage mechanism. And there's an opportunity to monetize some of that. And I think there's also opportunities in Ireland around the forestry theme. That was a feature of the Irish government Green Bond, and I think there is more to do there. There's a huge interest at the moment in carbon offsets and carbon credits, and I think there is an opportunity there in Ireland to establish a low risk stream of carbon credits based on afforestation projects. So moving on to the last two themes I wanted to cover were ESG Investor Expectation. This is something that we are very focused on because our clients are relying on us to help them understand, what ESG investors want. And what we're trying to do is to make sure we land any ESG debt proposition in the sweetest spot possible on the buy side. So reflecting back ESG investor expectations as they evolve is very important. I would say in broad terms, we have been at a point where everybody is learning as they go. But now that the ESG debt capital markets is sizable, there is, I think, a desire to become more discerning within that. And so investors now have higher expectations in terms of defining green, if you will. And they also have higher expectations when it comes to demonstrating ambition. In the case of a sustainability-linked bond, for example, investors want to hear, well, does this sustainability-linked bond communicate a corporate strategy to evolve the company in a way which would meet the Paris Agreement on climate change objectives, as an example. So investors definitely becoming more sophisticated, more discerning, and what we are trying to do when we're helping our clients is make sure that we reflect those evolving investor expectations. And then the last point I just wanted to cover was around maintaining integrity. You will hear and read a lot in the press about greenwashing and social washing and all sorts of things. And, that is a danger that I guess we need to guard against, which is why we have the green and the social sustainability linked bond principles that, are administered by ICMA. And that has, really helped put the market on a sort of a firm footing. But within that, there is a need to, not to be over optimistic around the green propositions that we see sometimes in the market. The reality is for many issuers and for many ESG related themes, in fact, there's no clear green outcome. There's a series of trade-offs, and what we're doing is expressing a preference for one trade-off, but we have to acknowledge that pursuit of some of these priorities from an ESG perspective is accompanied with some downsides. So as an example, if everybody piles into renewable energy, there will be some trade-offs there in terms of, the impact of this infrastructure on the environment. And it's the same for any infrastructure development and any technology. We have to sort of accept that, and I think investors are becoming more sensitized to that. When it comes to the sustainability-linked bonds, where we set a corporate objective and we link the bond, the coupons, as an example, to the achievement of those objectives, investors are expecting a demonstration that the ESG issue is relevant, core and material to the issuer's business, and also that the ambitions that are being set are meaningful, and that the penalty that would be incurred if the targets are missed is also meaningful. They want to see teeth. So they're just two themes to pick up on, because that is, they are two common sort of feedback points from investors when we're out in the market, in this sort of current issuance environment. I will just leave you with the final thought, which is really in summary that Irish issuers are off to a good start. Under the sort of guidance and the leadership established by the Irish sovereign, there are huge opportunities to demonstrate, what can be done in terms of harnessing renewable energy and making sure that we have enough renewable energy as an input into the overall effort to green the economy. I think Ireland has a great opportunity to show, what can be done in terms of making progress toward a genuinely sustainable economy. So I will pause there. I am out of time, but just wanted to say thank you very much to ICMA and Allied Irish Banks for the invite. Thank you.
Thanks very much, Paul. So delighted to have you join us and get the webinar started with some interesting observations and themes. So I won't delay. Next up, we have Amy West from TD Securities, who's going to be moderating the first panel, which focuses on regulation. Amy is the Global Head of Sustainable Finance and Climate Transition for TD Securities. Is the chair of the Sustainable Finance Hub within TD and is quite active at an industry level, involved in ICMA working groups. So, as I said, it won't hold things up, and delighted to hand over to Amy.
Thank you so much, Mark, and thank you everyone for dialing in or logging in today. Great to have Nicholas and Paul introducing us, and delighted to have the panelists here today to really talk a little bit more about how we're seeing changes within the ESG lens and capital markets, and particularly in Ireland. As Mark very kindly said, my name is Amy West. I'm the Global Head and Managing Director and Global Head of Sustainable Finance and Corporate Transitions at TD Securities. And so really part of our remit is to bring global reach to these topics, but today very excited to talk specifically about what's going on in Ireland. From our perspective, increased regulation on ESG products and more transparent disclosure requirements have dominated sustainability discussions over the past year. Europe has clearly been at the forefront of this debate, and its legislative action has served as an example for many other countries. What we are going to discuss today is what has been the impact on financial markets. How have European institutions, and particularly Irish institutions, reacted? And what does it mean for other financial market participants? So joining me today to dissect and dive deeper into these topics are my three esteemed colleagues. I'm actually going to hand it over to each of them to introduce themselves, but we have McCann Fitzgerald, AIB, and Arthur Cox on the panel. So maybe Aidan, if you wouldn't mind, you could start off introducing yourself and what in particular you do for your firm.
Absolutely. Hi, everyone. My name is Aidan O'Mahony. I'm an ESG funding specialist working in AIB, and I would have been responsible for putting together our green and social frameworks and also running the programs that underpin them. So I throw it to you then, Brendan. I think you're on mute.
Thanks, Aidan. My name is Brendan Wallace. I'm a partner at Arthur Cox. We're an Irish law firm and a member of the ICMA Irish chapter. In my own practice, I advise both issuers and investors on capital market issues and on regulatory questions relating to ESG and other matters.
Hi, my name is Eamon OConnell. I'm a partner in our finance team in McCann Fitzgerald, focusing mainly on debt capital markets and corporate lending. So McCann Fitzgerald have been involved in some of the significant transactions in the Irish ESG market to date, including advising the NTMA on Ireland's first green bond and advising ESB on on Ireland's first corporate public green bond. So we've had a significant role to date in this space.
Perfect. Well, thank you all for sharing your backgrounds and what you do. Maybe Eamon, we'll start with you, since you have the illustrious position of being the last to introduce yourself. ESG has clearly been transformational. I mean, the fact that we're sitting here today, we have two lawyers on the panel that are discussing this, obviously shows you that creating an entire ecosystem now we have of specialists and organizations and services. Maybe you could talk a little bit around how ESG has affected the legal field so far. And then I'd also be curious your view on any anticipated changes coming down the pipe.
Sure. So, I mean, the ESG revolution is really having a huge impact on how we deliver our services. So that's for a number of reasons, the rapidly changing legal and regulatory environment, but also the focus that we're seeing from our clients, be they investors, be they issuers, or other stakeholders in society generally on ESG risks and opportunities. And that really, I suppose, the advices we're giving and the issues that clients are asking us to address really stem from the wide range of issues that come under the ESG banner, the difficulties that can be there in trying to assess and identify those risks and opportunities, and also the difficulties that can exist in terms of trying to comply with regulatory standards. So our role is to advise our clients to use our sectoral experience and our expertise, but also to give them that 360-degree view of what's going on in terms of policy drivers, in terms of cross-sectoral initiatives, but also giving them that kind of sense of horizon scanning as well to tell them what's coming down the lines in terms of EU initiatives. And I think the biggest thing that we've noticed in the legal field is that ESG matters are now relevant to every client, no matter what sector they're in. So whether that's real estate, whether that's construction and planning, whether it's energy, whether it's litigation, whether it's finance in terms of green bond issuance, corporate lending, asset management, financial services, regulatory, you name it, all of those things are now relevant to our clients. So what we're finding is all of our teams across the firm are now engaged in those issues. And then there's that kind of internal piece as well, where we're looking at our own carbon footprint, where we're looking to reduce our own waste and our own water consumption. So there's an internal and an external focus there.
No, that's a great point. And Brendan, maybe I could pull you into this debate a little bit, to this discussion. In your opinion, what does the EU's rollout of regulatory standards and reporting requirements? And we've had quite a few. We have SFDR, we have CSRD, we have the EU taxonomy and the technical screening criteria. What does that mean for voluntary standards as you advise clients? When I say voluntary standards, I'm thinking of CDP or GRI, SASB, et cetera. Will these new standards displace the voluntary standards, or will they work alongside? And I think, one of the topics we hear a lot on the banking side is really around reporting fatigue. So I'd love to get your thoughts there.
Yeah, I mean, as Eamon said, there's so much under the ESG banner. So the reporting requirements that are coming in under the EU banner, obviously very impactful for issuers that are already in that space. So it's an interesting question as to whether that will displace the voluntary reporting that issuers may already have or be looking to do. And I think the answer to that lies with a couple of different constituencies. So between investors, issuers, and on the other hand, regulators or legislators as well. What we're hearing a lot from investors in the market in particular is that huge amounts of data is being provided to them on ESG metrics. And I think there's a difficulty at the moment in them for those investors in comparing the information they receive between the different voluntary standards, seeing how consistent it is, and in turn, I think translating that information into reporting that they're required to provide onto their investors or regulatory reporting they have to do. So from that perspective, what we're hearing is a wish for a move towards a more consistent standard of reporting, or maybe an easier way of reporting that onwards. So I think the EU taxonomy and the amendments to the SFDR and so on will probably start to displace, in some regard, the voluntary standards, or lead to a certain amount of convergence. And I think this is probably something that's been recognised by the bodies behind those reporting standards as well. So we've seen a number of initiatives from them, from discussions they had, a report late last year from, I think, what they call the G5 reporting, so SASB and others, CDP and others, and outlining what they think their shared vision is for how there might be convergence or more comprehensive corporate reporting from. So that I think is recognised. So I think the result from that will be that there will be increased standardisation, and I think it will be driven by those mandatory standards like SFDR and CSRD and the EU's taxonomy screening. It'll all be interesting to see what happens with the IFRS, and they are talking about whether they will develop an international sustainability standards board. I think they're probably due to make a decision on that ahead of COP26. So I mean, that'll be another space that will be more global than the EU requirements. I think the other piece of that jigsaw then is about issuers. And I think really what it highlights for issuers is the requirement for them to have good data gathering in the first place, because you don't know what exactly is going to be the requirements coming down the tracks in years to come. So having those processes in place for issuers is a practical steps they can take to at least be prepared if there are changes, phasing out those mandatory standards, notwithstanding the incentive they have, I'm sure, to stick with the reporting they have.
Absolutely. And I will say to the audience, I apologize I didn't say this earlier, if you have any questions, please do put them in the chat. We'll do our best to answer them. But Brendan and Eamon, you guys actually have got the first question coming back from the audience for our panel today. So maybe I'll ask it quickly, which is, what do you think will be the impact of the draft social taxonomy? Do you think it will become as important to investors as sustainable/green finance? And Aidan, I'd also love to get your perspective on this, obviously, as an issuer on the group.
I'm happy to jump in there first then and hand it over to you, Eamon. I think there is a theme in the ESG markets at the moment that data and reporting are very important, and how the whole ecosystem of raising finance works, and how people can point to what actually is ESG and deliverable outcomes from it. We've seen green garner quite a part of the market, and sustainable finance, sustainable and social is now, I think, what is the next area of growth. We see it, it is the most fastly growing area in the ESG, the S. So I do think that as the social taxonomy or more guidance on that develops, that will just help that along. I think it will actually be quite impactful.
Yeah, I'd agree with that. I mean, whether it becomes as important, I suppose, depends. I think there's a pretty pressing need on the climate side. So I think that is, I suppose, being an area of focus for a lot of investors. There was a report out by the Platform on Sustainable Finance, which is talking about extending the taxonomy for social objectives. And it's quite an interesting discussion in their report as well, which talks about, I suppose, even coming up with metrics and objectives to include within that social sphere as well. So it is, as Brendan has said, particularly during the COVID period over the last 18 to 20 months, there's been an explosion in social bonds. So I think it is going to be important. Whether it becomes as important, time will tell. I think there will be quite a focus on, climate-related initiatives over the coming period. But it certainly will be an important feature of the kind of sustainable finance ecosystem. I think that's for sure.
Yeah, I would go along with what Eamon says. Certainly in the short term, I think green is going to remain preeminent in the marketplace. The demand is still, most SRI, socially responsible investors, they primarily look at green. It's the first thing they want to see, but social has been gaining ground rapidly in the last year and a half. And I think COVID moved that up the agenda even further and faster than was previously anticipated. So over the medium to long term, I see green and social sitting beside each other, side by side, but it's a few years away. We have so much more of a regulatory backdrop for green. It's much more established. There's much more in terms of ESG rating agencies are much more comfortable and focused on green as well. So I see green remaining preeminent, at least in the short term, but medium to long, I do think the two will become as important as each other. And you'll see issuers with what are called umbrella frameworks to cover both, and issuing a green and social bonds almost at the same time.
Yeah, Aidan, I agree with you. Last year was such a turning point because I think from the issuer side, we've always been a little bit concerned around, we have a lot of tools to measure green. How do we think about social? And so, going forward, just to see the EU come out with this draft social framework will be, I think, a huge step in the right direction, not just in the EU, but globally. And I guess when it rains, it pours. So we have one more question from the audience. I'm actually going to come back to you, Eamon and Brendan. But how is the legal sector dealing with documentation and in particular audit trails? Traditionally, there's been a reliance on paper documentation for contracts, security and compliance reasons, which has a large carbon footprint, and the transition to digital methods to reduce the carbon footprint. Love to just get your take on that question.
Yeah, it's an interesting one. And I think in many ways, the transition to kind of the home working environment probably reduced quite a bit the paper output of law firms throughout the period of the last 20 months. So I think what you're seeing is an increasingly digitized, framework for law firms to work, and correspondence and things happens over email. There's less printing, there's less output in that sense. So I think it is having work practices are definitely changing, and I think more things are going online, and you see that with electronic signatures and electronic documents. I think that is becoming much more mainstream. So I think there's definitely a shift away from physical documentation, although obviously they still have their place and they're still quite important. But I think there's definitely a reduction in the paper output of law firms over the past while.
Yeah, I'd agree with that. I mean, really, COVID has been a big driver that we talked about having or moving towards a paperless office, but I think actually being away from the office with the paper is something that's helped a lot with that. But I think the other big lever has been as well. I mean, law firms, along with other corporate entities, have been thinking themselves about what their footprint is, what the carbon footprint is, and how they can be impactful in that space. So I think you see law firms kind of taking that momentum forward when they look at their work practices as well, and how in the whole process of what we do in providing services to clients can take down that carbon footprint through eliminating paper and otherwise.
Perfect. Thank you both. Maybe just coming back a little bit, one last question I wanted to ask on the regulation side before we move on. And Aidan, I would love to get your perspective on this. The EU taxonomy is coming into force at the start of next year. What do you think the main challenges will be for European banks in particular?
It's simple, and Brendan's already alluded to it a couple of times. It's going to be data and reporting. The taxonomy solved a major issue for European industry in that we now have clear definitions of what qualifies as green lending. Where we accept that the question of nuclear power and the status of natural gas remains outstanding, but by and large, we now know what can be defined as green. So now that we know what can be defined as green and non-green, how do we report on our assets from an ESG perspective is the next big question. And the answer to that is simply gathering more and better ESG information on the borrower, the project, and the assets that we will be funding. We need to do that in a way that we can prove taxonomy compliance and report an accurate green lending ratio. I think this is going to require systems and mentality changes within banks. For a long time, banks have been very good at gathering credit information, and we need to get just as good at gathering ESG information and having it available on systems in such a way that it can be, digested in an aggregate form, and also on an individual loan basis, make it auditable so that we can prove taxonomy requirements. It's going to require IT investments to overhaul systems, and also, and just as importantly, ensuring that staff in organizations are engaged with this issue and have actively bought into tackling the challenge that this presents. If I were to use our own green bond framework as an example, just recently we're going through an update process, and last year second party opinion providers didn't offer a service called taxonomy compliance assessment. Now they do, and this means that they will assess the assets that are in your pool and give you a percentage compliance with the EU taxonomy regulations. And while we might believe that all the assets in our pool are green and fully compliant with the taxonomy, proving it is another matter. And it can go into very minute detail, the burden of proof. If you have a commercial property over 5,000 square meters, they look at every aspect of that property to ensure that it meets taxonomy standards. And it's just data that simply doesn't necessarily exist yet. And we're going to have to get better at capturing it and holding it on our systems. And if we're going to accurately disclose green lending ratios, this type of work just has to be undertaken despite the reporting fatigue that's already present in the industry. And I think because of that, it'll need to be pushed from the tops of organizations, as we're lucky to have it pushed from an AIB.
I absolutely agree. I think both as a fellow individual to bank, but also just generally in the market, data is going to be one of the preeminent themes for years to come as we all work on this. Maybe I'll circle back to you, Eamon, because I love what Aidan was saying there. Regulation and disclosure inevitably are somewhat in parallel. And so what do you think we'll need on the data front to support these upcoming regulations?
Yeah, I mean, European ESG regulations have been mainly about disclosure to date. And the reason for that is that there's an attempt there to increase transparency and to reduce greenwashing. But I think when you take a step back, what you're seeing evolve is a comprehensive, detailed, granular, and standardized reporting regime on sustainability matters that is being constructed in real time at a European level. And that's going to be underpinned by mandatory reporting standards, which are being developed under the CSRD. So I think when you see that being built and when you realize the sheer scale and the timing of that, it's creating huge logistical issues for any in-scope entities, be they banks, asset managers, insurance companies, large corporates, and any other entity that is subject to those obligations. And kind of to expand on what Aidan was saying there, I mean, if you look at a bank, it's going to be subject to disclosure requirements under the taxonomy regulation. That's the first thing. Depending on its activities, it may also be covered by SFDR. It'll be covered by CSRD. It's going to be covered by its prudential oversight and oversight framework. So that will include disclosures under Pillar 3. It'll have climate stress tests. It will have its it will also have its the supervisory review and evaluation process. Then you've got potential corporate governance rules coming down the tracks. And that's even before you consider the fact that we have delegated acts to come out for the remaining 4 environmental objectives under the taxonomy regulation. They're talking about expanding that to cover social matters. And they're also talking about expanding it to cover harmful activities and also to cover intermediate activities. So that gives you a sense of the scale and the scope of the issues that are going to be faced by banks and by other institutions, the capacity building that's going to be required. And as Aidan says, I mean, there are significant issues with the data there. There's the availability of data, particularly when you're getting down to retail and SME clients. There's the quality of that data. There's the fact that it's not standardized. There's the fact that it's not comparable. There's the cost of accessing the data. There's the fact that it's not verified. And then even when you collect all of that data, you have to build an infrastructure to process it, to aggregate it, to make it machine readable. So this gives you a sense of we're trying to effectively mimic and elevate sustainability reporting to financial reporting, except financial reporting has evolved over a period of decades. But we're trying to do this with sustainability reporting over a period of years. And that's the real challenge, that infrastructure didn't exist up until a few years ago, and it's being built from scratch now. And that's a huge challenge.
And maybe I'd love to ask a question to the panel, hopefully not too provocative, but I think Aidan actually brought up some of the ESG data that banks are working on and how you embed that into your processes, your systems, your lending. On the disclosure side, obviously, I mean, you've made some really good points. So I have to ask the question, will corporates be punished for not properly disclosing?
Well, I might come in on that one straight away, that Amy. I think it's a carrot and a stick approach here. So from a regulatory point of view, there may be some, there may be some sort of punishments in the future for not doing proper disclosing. But leaving that to one side, if a corporate wants to currently avail of better rates on lending products, there are products available in the international markets, such as sustainably linked lending, that will give them preferential treatment if they can prove certain levels of sustainability and progress. We can see the examples of that at an individual level within AIB where that green mortgage proposition, green personal loan, preferential financing rates on electric vehicles. Then at the corporate level, the well-established sustainability linked lending that I'd mentioned, that's also in place at AIB. So look, there will probably be carrots to begin with. And if the carrots aren't working, a stick may come along.
I think that's right. I think what you'll see ultimately is sustainability being integrated into the process relating to the assessment of a borrower in the same way that credit is. I mean, I think that ultimately the end goal where you'll end up is that banks will be carrying out that assessment together with the credit assessment. There'll be dual assessments effectively.
Yeah, agreed. I mean, one thing we've heard in recent years very strongly from investors, from people who are looking to purchase bonds issued on the bond markets, is that they want to hear from issuers about their sustainability metrics, even where they are maybe brown in color in terms of how to categorize them, to hear a plan for how they will improve that. And I think that the next level on that is that if those issuers can't provide the metrics on how they are operating, they won't be able to take advantage of those opportunities, like Aidan said, and actually build that into the reporting metrics like Eamon has been speaking about.
So before we continue moving on, I want to actually ask a quick question on something you said earlier, Aidan, which is around social. And the S part of ESG has been perceived as harder to evaluate. It's more qualitative. We have this huge push towards data, and yet the S is a little elusive. I'd be curious if you could share with the group, since we are on an ICMA panel, how was the experience setting up your recent social framework compared to when you set up your initial green framework? Was it easier? Was it harder? And was it easier had you already gone through the green process?
Yeah, that's a good question, Amy, because it's easier in one respect and harder in another. And what I mean by that is it was much easier from a project planning point of view because we had the experience of doing the green. We knew who the key people were in the key areas of the organization that we needed to speak to. We had internal working groups already set up and ready to go. There was terrific buy-in, I have to say, from staff and our lenders and their business leaders, because the ESG agenda has really embedded in AIB over the last 3 years. So while you may have been, pushing the door a little bit to set up the green at the time, the door is wide open now for any kind of ESG initiative in AIB. And that's great to see. That shows a real mentality change within the organization that made the whole process so much easier for us. However, you've alluded to the fact that social it's a little bit more elusive to pin down than green. And look, the reasons are obvious. Green is concerned with carbon reduction. There are accepted carbon accounting methodologies that exist out there in the world that you can use to show the benefits of your lending. But as far as I'm aware, there's no social benefit accounting methodology available. So ascertaining the exact benefits that your lending is going to give is a bit more difficult. And not only that, but also selecting the assets that you would use in your pool is a little bit more elusive. It's not as clearly defined. We've had the ICMA Green Bond Principles for quite a while. That's now backed by a regulatory backdrop with the EU taxonomy. So there's really robust guidance available to you to decide what kind of assets are green or not green. Whereas, say, with the social aspects here, with social bonds, that doesn't exist. You've only got the ICMA social bond principles really to rely on at the moment. And I do note that the recent July report on how they're going to go about putting together an EU social taxonomy was released. And personally, I was relieved to see the major categories we have in our own social framework called out as areas that will require objective setting. But look, and then there's the issue of reporting that we've already alluded to. How do you work out the impacts? It's far more challenging. So in one respect, because we could lean on the structures and the governance we put in place for the green, it was much easier, but it was also much more difficult just simply from getting on top of the issue, because the materials don't exist in the background. And we also were the first Irish corporate to do a social, so we had nothing that we could look to. It was an entirely new thing for an Irish corporate entity. So there was pros and cons, but overall the process was about the same, simply because if we did it first, it would have been much harder than doing green. That's for sure.
I think that makes sense. And thanks for the candor around walking through the process. Just jumping in now a little bit more to products. I think that the sustainable financial markets, without question, have taken off at an incredible pace. All of us that were in the markets when the pandemic hit last year, I'll be the first to admit, I was a little nervous around how ESG was going to be received when we were all just trying to make sure, our businesses stayed operational and profitable. So one thing I would be curious about, in the sustainable financial markets, we're now on track to exceed 1 trillion euros for the first time this year, and that's according to S&P forecasts. As we're seeing uptake from these sustainable investment products grow, obviously we've seen an increase in investor scrutiny, and in particular around mounting concerns of greenwashing or ESG washing in the sustainable marketplace. Maybe I could start asking you, Brendan, what can really be done to address these concerns? And are there any other measures that might encourage sustainable investment but minimize greenwashing at the same time?
Yeah, it's a tricky one. I mean, it's clear that greenwashing really is a concern. We see the surveys coming out saying among ESG investors, greenwashing is the item that will focus on the most in terms of things that might concern them. So I think there's a difficulty in encouraging further move into ESG. Maybe a tension between encouraging further people to go into ESG while minimizing greenwashing. In that the more funds that are chasing things that are labeled ESG, I guess the more opportunity there are around the edges for issuers who to date haven't been rebuilding ESG into what they do to do something which may amount to which may not fully align with investor expectations, maybe to put it that way. And that kind of leads to the question of what is greenwashing. So I think maybe the key measures that can encourage that will be around those type of developments that we've been discussing so far on the reporting and a metrics side, about having clear standards, disclosure regime, shared understanding of what those metrics mean. So, for instance, the EU, the SFDR, and disclosure requirements under that, the EU taxonomy and the technical screening criteria, which get quite granular. So, in that way, it can effectively minimize greenwashing by allowing people to call out what is seen as not meeting the criteria. I mean, so part of that I think will also be driven outside the metrics framework. So a question of culture in corporates and institutions as well. So equity investors will have their part to play, I think, in looking at the culture of institutions and corporates that are issuing and involved in putting together green products, that they are not just trying to put something on their label that doesn't really fit, but because ESG, to be successful, has to be embedded really into strategy of an institution. So, I mean, Aidan talked about it being led from the top, in terms of making ESG part of your business processes and what you do, your core vision. I think that is actually a very maybe underspoken about part of what can enable ESG to be successful, minimize things like greenwashing. Of course, there's always a question of regulation. But lawyers will talk about regulation. What measures might be taken of people who are maybe involved in greenwashing. That's really in a developing space, because the standards are really only developing. I mean, we've seen reports of one asset manager recently who reports of an investigation, maybe because they overstated the ESG credentials for some of their products. I mean, that's always, I think, as the market develops further and as the standards develop further, that also will be maybe the stick in the carrot and stick when it comes to ESG and keeping people on the straight and narrow.
Yeah, I just go in on that as well. And I think what you'll probably see I think it's already kind of come within the spotlight of the European Commission, who are looking at this market and saying, well, actually, we really need to do something here to maintain the integrity of the market. So they published their renewed finance strategy during the summer, and in it they mention potentially putting into the prospectus regime minimum standards in relation to ESG securities in terms of disclosure. And then the other thing they're talking about is developing standards for things like sustainability linked bonds as well. So particularly in the bond market, there may be action there. And then the other thing that Brendan mentioned about, there's always that risk if somebody overstates their credentials and publish strategies about their sustainability credentials, you're seeing heightened levels of ESG litigation now, where people are taking companies to task for making claims that are not credible. So I think that's something that corporates, their boards, are very aware of, and that they're becoming increasingly conscious of when they're making public statements as to their strategies and as to the goals, that they have to be credible.
And Amy, if I could just make a final point on this one, and I agree with what Brendan and Amy were saying, but I also think second-party opinion providers have a role to play in this. It's hoped by the end of this year, the SPO providers will be able to offer an EU green bond standard kind of compliance assessment under the supervision of regulators. Having something like that in place will really help with greenwashing concerns. To know that our SPO providers are now, regulated in how they're going about doing these assessments, it gives you greater confidence that when you see the SPO and that they essentially give it its blessing that this is a green transaction, you can put a lot of faith in it. So I think there's a role to play for the SPO providers in this as well.
And you guys actually already answered my next question, which was going to be around, do you think that we're going to see regulation of different proposals like the EU green bond standards? Seems like everyone's in consensus. So I'll ask a follow-up question, which is, I'm quite curious, while obviously European issuers will be in scope, how do we think about this for non-European issuers? They're obviously not in scope. They're not going to be forced to be regulated for the EU taxonomy. So how will the focus on the EU's regulatory standards impact issuers looking at the Euro market? We actually just had an audience question asking something very similar. Is the panel concerned that international issuers will gravitate to a more accommodating or less strenuous market or data regime if available? I'd love your thoughts on that as a group.
Yeah, I could come in on certainly on that last question. I think we've certainly noticed it in our own dealings with investors that they're increasingly sophisticated in themselves, and they're relying less and less on verification from third parties anyway. And some of them are setting standards that are even in excess of kind of the EU taxonomy for what they consider to be green. And if you don't meet their standards, you don't get their investment. So this increasing level of sophistication that we're seeing amongst investors probably means that if someone is trying to jump to a more accommodating region, I would imagine investors will be on top of that quite quickly, and you will not see, you would see deals like that struggling more than if they were in doing the higher standards. Having said all that, I also think that issuers, that making their, if you want to make investment decisions, now you need to be that increasing level of sophistication, because ultimately investors are going to make their own decisions on ESG credentials and standards that they adhere to. And I actually see a situation where into the future, you'll have a holistic ESG assessment of the company done by your prospective investor, where they won't just look at your framework, your SPO and other things like that. They'll take a look at the whole company, and you'll have a credit assessment and an ESG assessment. And whether you're jumping around to more accommodating regimes or not, if you don't meet that investor's ESG requirements, you're not going to get an investment.
I think that's right. I'd agree with that. And I think it just depends on where issuers are looking to raise capital. But certainly if they're coming into the European market looking to raise capital, well, then those European institutional investors are going to effectively apply the rules that apply to them. So, they're going to have powerful incentives to invest in assets that are, for example, taxonomy aligned. I think that's probably going to be one of the powerful incentives for issuers to issue green bonds in accordance with the new green bond standard, is because institutional investors, banks and others will be incentivized because of the reporting regime to which they're subject, because of the fact that they have to disclose how taxonomy aligned their investments are. That's going to be a powerful incentive there. That being said, I think depending on where you're trying to raise capital, there are other taxonomies being created in other parts of the world. So I think where people are under a different regime or subject to a different regime, they'll probably in the main sense apply that to their ordinary course business, but it just depends on the type of product and where they're looking to raise money, as I said.
Yeah, great. I think you see some of that geographic distinction in terms of where issuers may look, what main markets they may look to now, because those pieces of regulations, I said, like SFDR will, albeit not extraterritorial, will have effectively a trickle-down extraterritorial effect, because those, let's say, investment managers, for example, will need to get that data and need to be able to verify that. So that'll feed in.
So I do want to make sure I come back to one capital markets product, and data keeps coming up, and it's going to keep coming up. But Aid, maybe I could come back to you. Obviously, you've done use of proceeds bond. As we heard from Nicholas and some of the work that's being done, as we heard from Paul, we're also seeing a huge amount of focus around sustainability-linked debt products that have really come into the forefront this year. I'd be curious, do you see use of proceeds bonds and sustainability-linked bonds as complementary, or do you think that one will, over time, prevail over the other?
Well, speaking for myself, since their emergence, I've not really liked sustainability-linked bonds for banks. And, there's three reasons for this. Like in the capital space, the incentive to redeem question is there, and that causes some issues that the EBA also highlighted. But look, my two main objections away from that really center on one, if an issuer commits to certain objectives as part of its SLB, say net zero by 2030, something like that, and how do you then go about proving that you've achieved that target to your investor? And if the investor disagrees with the methodology of the data you've used to arrive at your conclusion, do you open yourself up to litigation as a result? So that kind of muddies the waters a little bit for an issuer, and you don't like that. And those issues could be overcome if there's a regulatory backed way to prove your metrics are being met. But even if that were to be the case, I still have another issue in that I don't understand why a bank would prefer a sustainability linked bond over use of proceeds, just given the nature of the banking business. I mean, banks, right? We have assets on our balance sheet that we earn interest on. That's how banks ultimately make money. So when you can go and select some of those assets, place them in a pool, and then issue your bond on the back of that, rather than setting, corporate-wide sustainability objectives that you then have to drive and measure and all the rest of that, I think it's much simpler, a much more straightforward process for a bank to have a use of proceeds. Now, having said all that, I do think there's a future for SLBs. I think SLBs are working well and will continue to work well for, say, large-scale project-specific financing for corporates, where the sustainability targets of the project can be baked right in. There's certainly a future for them there. As to which will prevail over the other, in the medium to long term, I've alluded to it already. I actually see a situation where both types will fall away, and then you end up in a situation where there will be a holistic ESG assessment of the institution that's looking for an investment. You'll go and meet your investor, and you'll have a credit analyst and an ESG analyst sitting side by side, and you'll need to satisfy the requirements of both to get your investment. Now credit will always be king. This is banking. Credit will always be king, but a company with awful ESG ratings or history may not get the investment, even if their credit is absolutely unquestionable. And that's some of the reason why I see the role of the ESG rating agencies and analysts really growing importance for financial markets over the next few years.
We actually have a question from the audience that dovetails nicely into some of what you've said here, which is, do you see in the future competition amongst corporates or banks to have better KPIs? And namely, they're asking about the green asset ratio. And is that a metric that you think investors and capital providers could actually look at amongst peers and comparable institutions? And I'd ask that question to all three of you as well.
Well, from my point of view, banks already compete, right, with KPIs to have the best KPIs, and the green asset lend ratio is just going to become a new one that gets added to the list. This is being investor driven, this ESG movement, and investors are interested in those numbers. So it will become a new KPI on which banks compete with each other. So I don't see why it wouldn't.
I think that's right. And the other side of that, of course, is kind of at the activist level. So we see activists targeting financial institutions that are not seen to be, that are financing certain types of projects, but also are seen as climate laggards or are not performing. So I think this is going to be another indicator that if you're performing poorly on this one, then you may become a target for activists in terms of, protest and other types of action, including shareholder action as well.
And I'll just hop in. I know we're getting very close to the end of time, so I wanted to ask one last question while I have all of you on the line today. All of the net zero goals until now have been voluntary and aspirational, and now we're approaching COP21 in 26. Ooh, Freudian slip. Here in just a few weeks, maybe months. And I think that 2021 has been a bit of a turning point. Activists have won seats on major boards that I don't think any of us ever expected to see. We've seen a number of situations where they have prevailed in court cases against well-known corporates. And now we're heading into COP26, where countries are going to be refreshing their national climate commitments. And some establishment potentially of shorter term targets as well. We're no longer just going to say 2050 is enough, but what do these interim targets look like? I'd be curious from your perspectives, what do you expect to see, and what do you hope to see coming out of COP26? And I'd ask, more specifically, what do you want to see from Ireland? How can Ireland continue to position itself as a leader within this evolving landscape?
Well, maybe I'd kind of highlight the sort of what I'd hope to see coming out of COP26. And for me, there are four things really. The main thing that I think everyone wants to see, and really will be the major part of how this conference is viewed as a success or a failure, is the resolution of Article 6 from the Paris Climate Agreement. And for those who may not be aware, this centers on the issue of trading what's called mitigating actions. Essentially, this means trading carbon savings between entities and across jurisdictions. There's still no resolution on a common methodology for accounting for these carbon savings. The mechanism for implementing it is yet to be decided. And the third question that's really coming up is, how do you assess non-market actions? And those non-market actions are actions which won't result in a carbon credit, but are still considered to be good for sustainable development, like investment in poverty eradication and things like that. How do you get treatment for that? So I think that's a critical thing that has to come out of COP26 for it to be viewed as a success. The second item is the completion of the 100 billion financing agreement between developed and developing countries. With the further, this was supposed to be completed by 2020, but we've seen no reporting on whether it's been done or how it's been completed. There's a further 100 billion due by 2025, and we need to know what happens after 2025 as well. I know developing nations have requested a status report and update on this. That developed nations have been slow to provide, but I think one is due at the conference, so that'll be something I'd like to see interesting coming out of it. And then the last two are really kind of tied together. It's a moving of emphasis in a little bit. And the first would be to other green issues away from carbon production, such as more emphasis on biodiversity and habitat protection. Those are becoming increasingly recognized as being extremely important for the environment. It's not just about carbon anymore. And then finally, I'd like to see a little bit of, perhaps selfishly, given the work we've just done here in AIB, I'd like to see a little bit more emphasis on the social aspect of the ESG agenda at these conferences. This could come in the form of, even if it's just ambitions, to create targets in areas like education, healthcare, and other essential services. And I know there's meetings going on the sidelines at COP to discuss this, but I'd still expect the E of the ESG to dominate. However, I would like to see a little bit of movement towards the S.
Yeah, I'd agree with all of that. And I think the big thing that we're hoping to see is detailed policies in terms of implementing the ambitions that have been previously set out. And I think it was a bit alarming over the past few days when you had this UN synthesis report, which estimated that based on the current NDCs of countries, we were looking at a 16% increase in emissions between 2010 and 2030. I think that's really alarming, given I think we needed a 45% reduction in that time frame to achieve 1.5 degrees and a 25% reduction to achieve 2 degrees warming by the end of the century. So I think, there's a huge amount of action that needs to happen in terms of policies, relating to global electrification, integration of renewables, carbon pricing, all of those things. It's fine to kind of have these lofty ambitions which are set 30 years into the future, but we actually need to, we're running out of time to actually implement the policies that will achieve those gains. So I think we probably need a shorter term focus in many ways. In terms of the Irish approach to these matters, over the past few months, we've adopted a climate action act, which is really interesting. It sets out, our goal, our broad ambition to be net zero by 2050 and a 51% reduction target by 2030. But again, in terms of the detail, it kind of sets out a process for preparing carbon budgets relating to each sector, which effectively will impose an emissions ceiling on each sector. And then there'll be a climate action plan to actually set out the detail in terms of how that's going to be implemented. So I think that's really, really welcome, because I think it is that detail. I think we're probably all used to hearing about ambitions in the long term, but it's that detail and how it will impact on sectors, on economies, on people's lives. That's what we really need to see, and what people need to see to have visibility on.
And Brendan, anything you'd like to add before we sign off today?
Well, I think Eamon and Aidan have covered that pretty comprehensively. It sums up to say, and I think there's been a real kind of momentum and push behind this in the run up to COP26, that the time for intergovernmental, as Eamon put them, lofty goals distant in the future has passed, and it's clear to everybody that the pressing need for more comprehensive, shorter term actions to be taken.
Well, I think that's the perfect note to end on, and thank you all for your opinions and for sharing your viewpoints and your expertise today. It was a pleasure, and with that, I think we're going to be handing it back over to Mark and the ICMA team to take us to the next item on the agenda. Thank you for your time today.
So we're going to move to our second panel discussion, which is going to be moderated by Caroline Haas from NatWest Markets. Caroline is the Managing Director and Head of Climate and ESG Capital Markets, and is quite active across the industry, participating in ICMA working groups with the LSC and with AFME. So no further ado, I'll hand over to Caroline.
So first of all, thank you very much for your time this afternoon, and also for the invitation to moderate this very esteemed panel. Today's conversation will be focused, or this afternoon's conversation will be focused on, how we incorporate sort of sustainability strategies into the overriding or underlying green and social bond transactions. And as we were seeing, there's a lot more sort of purpose-driven strategies coming out, and we've obviously seen that also with the sovereigns very much now supporting the environmental objectives and aiming for net zero, and how that then feeds into the green issuance plans. And so as a result, we've obviously seen the green and social bond market literally explode over the last sort of 18 months. I always kind of refer back to May 2020 as when we reached 1 trillion outstanding. And as previously already mentioned in the other panel, we are very much expecting 1 trillion of new issuance in 2021. That growth is extraordinary. It's incredibly positive, and it's lovely to see so many issuers coming on board. I think the other important thing to note is the diversification in this market, as more and more issuers really sort of want to support their sustainability strategies through the funding activities and the liability side of the balance sheet. And just as some of the touch points, 42% is now corporate issuance versus a 34% in 2020. And not to detract from what the supranationals are doing. Obviously, they still have an incredibly important role to play. Nevertheless, it just shows the growth and diversification. And what we've also seen, especially in 2021, is new sovereign issuers coming to the market. Spain just recently accessed the market, and most notably yesterday, it was the Green Gilt, which was 10 times oversubscribed, and the largest order book for a green sovereign at £100 million. And we're very fortunate. We also have an issuer who will also be shortly, who has just shortly launched their green bond framework for the NGU. And so again, it just shows diversification. And we, are a huge supporter of this and are looking forward to the panel. So what I would suggest is if I could maybe hand it over to Janice initially, and what we'll do is just if everyone could introduce themselves and also sort of incorporate how they have sort of interlinked their sustainability strategies with the respective funding. Janice?
So thank you, Caroline. So I'm Janice Daly, and I'm Head of Climate Action and Sustainable Finance for LeasePlan Corporation NV. And LeasePlan is a Dutch car as a service company, which in, I guess, old vernacular is a leasing company. We also have a banking license, and so we are a regulated financial institution under the ECB. In the sustainable finance arena, we are a regular issuer of green bonds. Having launched our inaugural bond in 2019, we've issued annually since, and actually twice in 2021, in February, and again just there in September. We currently have 3 billion in green bonds outstanding, and whilst green bonds do form part of our wider diversified funding strategy for the group, so we issue via debt capital markets in secured and unsecured format. We have a retail deposit platform, and we also have banking lines. Green bonds actually have a very specific function for the group, and in that they link directly to the business strategy. And that is a strategy where LeasePlan is looking to transition its entire fleet to zero emission mobility. Specifically, green bonds then also help to bring our ambition of being net zero from the funded fleet by 2030 to reality, and also help us in alignment with our commitment to decarbonisation along with the Paris Agreement and our commitment under SBTs. Green bonds obviously have a very important function there as well.
So my name is Mark Merrigan. I'm head of bond products and documentation at the NTMA. The NTMA is tasked with managing Ireland's sovereign debt on behalf of the Minister for Finance. So in short, we issued our first green bond, our inaugural green bond, in October 2018. So it's 3 years ago already, incredibly, and we have learned a huge amount since then. We've 6 billion nominal in issue. We've actually been able to allocate almost all of that across 3 separate allocation reports, and we've actually issued our second impact report at this point. So I'll pass it on to another colleague now. Thank you.
Why don't I then take it from Mark? Thank you. My name is Bernard Windisch. I'm in the Department for the European Commission. I think we are new to the block in the sense that we haven't actually had our inaugural fund yet. It's supposed to come out in early October. We've just published the framework for issuing green bonds under NGU. And we are now basically doing technical meetings with investors preparing the inaugural bond. Caroline mentioned very interestingly the link with the strategy for the Commission. Obviously, this is a hugely important topic. As most people may be aware, there is the green transition is an absolutely key cornerstone of the Commission's work and focus right now. There is the European Green Deal communication that was published as a starting point in early 2020 when the Commission came in. Since then, now just before the summer, the Fit for 55 package was adopted, where basically there is now a kind of goal to reduce carbon emissions by 55% by 2030 EU-wide. And obviously for us, this is also crucial to actually link up the expenditure side, which is obviously very important, with the revenue side of the budget. And here we have both made proposals on the side of the own resources, which basically finance the tax equivalent for the EU budget, that finance the budget, as well as having announced by the President last year that we would issue up to 250 billion in green bonds to finance Next Generation EU. So our outstanding volume obviously is zero, given that we haven't started yet, but we are expected to be one of, if not the biggest, green bond program in the world by the time that this is getting underway. So looking forward to the discussion. Thank you very much. I pass on to Richard, who.
Thanks, Bernard. Yeah, so my name is Richard Kelly. I'm a partner in the Finance and Capital Markets Department in Matheson, which is an Irish law firm. My practice involves advising issuers, arrangers, investors on corporate bonds, also on securitizations. And ESG has just been a major topic for us over the last 2 to 3 years. Obviously, as it has been with everyone else. We ourselves obviously don't have an ESG finance program where we issue, but you know, ESG is a major topic of discussion internally. I think every company and every business is becoming more mindful about what can they do to lessen the impact on the climate, from things as simple as getting rid of paper cups in our kitchens and replacing them with mugs that we can wash again, to looking at corporate PPAs and, you know, are there ways that we can use renewable energy to power our business. So it's just something that is applicable at all levels, from advising our clients to also being cognizant of how we act in our everyday life.
Terrific. Well, thank you very much. That's very insightful, and I think actually having the range here represented is actually really, really important. Janice, if I could maybe ask this question to you. Obviously in 2019, LeasePlan launched its inaugural green bond. It was a 5-year, 500 million green bond to finance the purchase of battery-powered electric vehicles, which attracted, and it came back to my sort of initial response of the oversubscription rates, 3.5 billion euros of demand, an incredible 7 times oversubscription. Since the initial transaction, LeasePlan has updated its green bond framework. What was the motivation? And, was that driven by some of the developing regulations, such as do no significant harm, or was it more sort of being more granular from the investors' questions and feeling that you needed to kind of update or upgrade the framework itself.
There we go. Sorry, my mute button was on. Yeah, actually, Caroline, it's a really nice question, and it's all of that actually. Yeah, so you're correct. We did our first green bond in 2019, and that was off our inaugural green bond framework. And we did update the framework. It was a very successful transaction, of course, inaugural, and we were very pleased with it. But we did update the framework, and that actually happened only 12 months later. So I think what that was reflective of was a number of items. I think you mentioned regulation, investors. I think it also stemmed from LeasePlan's maturity as a green bond issuer. I mean, you learn by doing. So that very first issuance and consequently interaction with investors, etc., gave us quite a lot of information for which we could effectively expand the framework. There was also a couple of very LeasePlan specific reasons for updating that framework, and you've touched quite lightly on the sort of linking to the strategy, etc. So maybe I'll just cover them briefly. I think first of all, yes, we issued in 19. The taxonomy was in development, but of course there was nothing really concrete there. But as we moved through 19 and into 20, it became very clear that this was going to be the environment in which we would be issuing going forward. So we started to introduce EU taxonomy language. So for instance, how our assets aligned to eligible assets or criteria under the EU taxonomy. We also stated how our framework aligned up to the environmental objectives. So in our case, climate mitigation, Objective 1, under Objective 1, and then we also started to introduce the language of do no significant harm. So at that point, obviously, we weren't able, and I think even with the developments that have happened in the last 12 to 24 months, we still wouldn't be able to say we've done a full assessment, but it wasn't really about that. It was more to start to bring the narrative in and the language in, that we understood the concept of do no significant harm, that we had looked along our value chain and looked along our supply chain and also within the assets to see where potential risks under that may lie and what areas would need to be addressed, and also what we already were addressing, let's say, and already pointing to international regulations, directives, etc., that the assets would be under. So that was really an introduction and sort of a line in the sand for us to our stakeholders and our investors, that we understood this and that we would be applying it going forward. Additionally, we also, I guess, maturity as an investor, we decided to expand our impact reporting to align to the harmonized framework of impact reporting under ICMA. That was something that we didn't have in the first framework, and of course adds a level of granularity, answering some investor questions specifically there as well. And then for the LeasePlan specific area, as I mentioned earlier, we have a diversified funding platform. So we actually expanded the green bond framework to be a green finance framework. Allowing ourselves to, for instance, look at green retail deposits under our retail arm, green loans. So we aligned to the green bond principles and the green loan principles. And also then we made some specific language and narrative around private placements, etc., because we do issue bonds in both public and private format and senior unsecured. So that was a big update, I suppose. And then finally, linking to the sustainability strategy, within that 12 months of our first issuance, LeasePlan exponentially grew in our sustainability strategy and the way in which we viewed sustainability within the group. We obviously have this net zero by 2030 ambition, and we have a business strategy which very much incorporates that environmental element. But of course, there was also areas in ES and G that were now being addressed, KPIs that were being monitored, etc. So we use the green bond framework and that update as a transmission channel, I suppose, for our investors and stakeholders to be able to understand LeasePlan as a sort of wider group, not just this very narrow definition of eligible assets, battery electric vehicles, and this is what we were doing, but also for them to understand more generally what LeasePlan as a group were undertaking in sustainability and sort of to demonstrate that growth in that 12 months from the previous issuance. And that framework was done in March 20, as I said, 12 months later, and we've had that in place. It was quite future-proofed, I suppose. But I guess what we see now is, again, our maturity as an issuer, but also, again, our maturity in our sustainability strategy. We're now doing TCFD reporting. We're looking at doing that over disclosures coming next year. We've committed to science-based targets. And so there's a lot of maturity ourselves that we eventually will want to bring into our next framework. And then also what we're seeing is indeed that regulatory environment, which we know with the EU Green Bond Standard, and of course reporting under EU taxonomy upcoming. So I think our next update will be as comprehensive, so it was driven by many factors, I think.
No, thank you. I think every issuer I've ever spoken to, as well as our own in-house It is a journey, and one is constantly sort of amending, altering, adding, and it's a combination of one's own internal, as you say, strategies, but also what's going on in the outside world. And that just shows with the speed and generation of this space. Also with regard to the reporting, things will start to become easier as it's homogenized and it becomes a little bit more aligned. And so as a result, you start to incorporate those changes into the frameworks as well. And, I think it was interesting when you said to have, a financing framework versus a bond framework. We've seen that very much in the market, very much obviously the instruments that you suggested, as well as obviously now moving further into asset-backed securities or into CP as well. And so really getting the full, if you will, menu of financing tools and instruments into the frameworks.
Yeah, exactly.
Now, if I could maybe now sort of turn it to initially first Mark and then Bernard, please. With regard to a sovereign, and I'm always a little bit careful what I call the EU, so I'll call you a quasi-sovereign, to kind of to sort of not bulk it all together in one go. But what have been the greatest hurdles that you've overcome when you were structuring a green bond framework? And I think, Mark, especially because, Ireland was very much at the forefront of this and very early, supported this market as a sovereign. And you must smile sometimes now seeing the other sovereigns following suit. But how are you sort of thinking about incorporating the pending regulations, obviously that Janice also talked about with regard to the do no significant harm, the EU taxonomy, EU green bond standard, and then sort of as we move probably further afield and start to look at global guidelines? If I could turn to you.
Thanks very much, Caroline. And it's 3 years ago since we issued the framework. So that's a long time in a market that is changing so rapidly and where so much regulation has appeared. So things changing very, very fast indeed. So it's incredibly exciting to be involved in it. So I suppose the simple answer to your question on hurdles is there are no hurdles now. That because it's so far in the rearview mirror. But I will share with the audience that when we did look at the whole idea of green bonds back in 2018, we did have to get our heads around, the concept of it for a sovereign in terms of, legal risk, the reputational risk issue if we weren't able to deliver on what investors would expect from us. And we got some great advice from various structuring advisors. And in fact, one of the earlier speakers, Paul O'Connor, was whispering in my ear for quite a lot of the preparatory period. I think the other hurdle is really, we are just debt managers here in the NTMA. We are not environmental. Well, I am not an environmental expert. So we did have to get a lot of advice from across the state, particularly from government departments such as the Public Expenditure and Reform Department and their climate unit, from the Department of the Environment and Climate Change and Communications. And we had to actually pluck some experts from those departments in order to put in front of investors to explain what the state's policy is in relation to climate-related matters. Indeed, then I suppose the other angle was political buy-in, because again, we are just debt managers and not responsible for policy. Politicians are ultimately responsible for that. And I know that there was some anxiety across some government departments that this would be part of government policy because it's basically an all-of-state project. It's not just the debt manager doing a solo run, right? Because you're completely reliant on the reporting that government departments provide. So we did actually have a government decision put in place back in July 2018, which effectively made the issuance of green bonds part of the state's policy. And indeed, then there was a working group to deliver on that assembled. I guess other hurdles you could reflect on are, the idea of having outside scrutiny from second-party opinion providers, and then just the sheer level of commitment and resources required for the annual reporting. But look, these are all hurdles that are in the rearview mirror at this stage. In terms of your question on the taxonomy, which is clearly knocking on our door at the moment, I mean, from our perspective, this is a great project which, you know, should help make Europe a great place to issue green bonds. I mean, I think that's the purpose behind it, and deliver on our on the Paris commitments. It is a complex area, however, and look, we are keeping a keen eye on it, on how it's developing, and how we might be able to knit it into our reporting. And I know that we're going to be talking about this in more detail later, so I'm just giving you a kind of a high-level overview. But look, debt management offices across Europe talk to each other all the time, as you'd expect. You know, there's a lot of chat and coordination that goes on, and that's no less the case on this particular topic. So it has definitely got the attention of those who have issued and those who plan to issue. So look, we have provided feedback through the NTMA has provided feedback to a group which our Department of Finance sits on, which is looking at how the taxonomy can be knitted through all of the state's reporting mechanisms, right? Not just the debt management channel. And we have provided feedback on the taxonomy and also on the green bond standard. So that policy item has been looked after in a different area. I would say one thing that for the audience to think about: sovereigns do a lot of things, right? It's not a corporate, you know, like a monoline business, you know, where you're producing, say, concrete, where you can measure the emissions from your business, etc. Sovereigns are involved in everything from clean water delivery to public transport to energy efficiency projects, pollution control projects, flood defense projects. It's very, very wide, and you know, it's a big ship to turn around. So that is something that is on our minds. So I know you'll be coming back to that in more detail later, Caroline, but that's first take on it.
Thank you. And maybe Bernard, as you're in the starting blocks, maybe if you could at least comment on the hurdles that you've had.
Yes, very much so. Thank you. No, I was listening with keen interest to what Mark was saying, and I couldn't help but notice that at the end the list was still actually a project list. And I think one of the key problems that we face in the sense as sovereigns, and also perhaps actually less for us, but still is there. There's a lot of recurring expenditure, pensions, social expenditure, medical expenditure, lots of kind of items that I think from a corporate perspective you have to very much less about, whereas actually projects and project finance are a much bigger part of your budget, which is actually similar to the EU, because we are a project, but we are not a project-based budget, but we are an investment-based budget, and that means that we do a lot less recurrent expenditure, which actually helps in that respect. And still, I think the taxonomy was and is one of the key issues that we faced and hurdles that we had. Also because at the time, even though we only come out now, all of these processes obviously have lead times that are a bit longer. And once the main legal basis under which we spend money, so the kind of laws that actually enable us to spend money, are fixed, it's very difficult ex post to change the conditions. So that means that in a way you need to in advance think about what conditions you actually want to have part of those laws in order to afterwards be able or allowed to kind of steer certain expenditures in a certain direction. Which brings me to the second point, that the EU budget, and particularly focusing on the green bond program, we are focusing on the Recovery and Resilience Facility. That's the huge 750 billion additional program that actually 670 billion out of the 750 billion. That actually is based on the plans that the member states submit for assessment to the Commission and then actually implement on their own budget, with, in a sense, the support from this program, which means basically that we are in a way one level higher up in the chain of distance to project. So even from actually the level that the sovereign budget is ready. So that is a significant challenge that we have to overcome. Already, basically, we're no longer looking at projects, as sovereigns also usually don't do. They look at programs. So a kind of class of, defining the class of projects, but where obviously then you no longer have a distinct handle on specific projects that you might have beyond what you've put in law. And we are again one level further up. So that's in a way the second big hurdle. And the third one is then reporting, because if you think about it, we are very, very far away from the person who actually receives the money, does something with it. And obviously we need the reporting flow to come back from that person basically through the whole food chain up to us. And I think in combination, those challenges have actually led to quite a few changes in the actual legal construction, which we were very fortunate to a certain extent we finalized in December, with some add-ons later in the earlier this year, in March and April. But it has, in a sense, led to a kind of partial alignment with the taxonomy, because, as you know, the taxonomy delegated act was only adopted, in a sense, in April. So we are aligned to the extent that we could anticipate, so to speak, what the taxonomy would say, and would be able to fit it into the place. But I think this is a real key problem, because I think when you set up these programs, also in the future going forward, I think it's very important in a sense to have, even for us, to have legal security in the sense of what the regulatory framework looks like, in order to be able to set up a decent program that then can be financed.
So I think there's some definite common themes. I think it's the future proofing. And then I don't think there's any issuer, it doesn't matter if it's a sovereign, a financial or a bank or a corporate, who hasn't said that all silos seems to have been broken to make one of these transactions work. And it's getting all that information. And obviously, the bigger the institution, the more complex to some extent to get that granular data to feed through again. But even, any corporate will have the same issues, where suddenly you've got treasuries working with the actual execution teams and the customer-facing teams to ensure that information comes back in through the system. So now a very interesting question has just come through on chat. And I think since we have both Mark and Bernard, who's just spoken about the sovereign, quasi-sovereign approach, which is very much based on use of proceeds. I think the question is interesting, and it's around sustainable linked bonds. And if either would consider something like that, or if they would be appropriate for sovereigns in its instance as well. Mark?
Thanks very much, Caroline. I saw the question come through, and I think it's a great question to generate what I would call a market announcement, which we're definitely not in the space of here, right? Let's be very, very clear about that. So as far as I know, I'm open to correction here. There are no sovereigns, certainly in my orbit, that have issued sustainability linked debt at all. I mean, obviously we've seen Luxembourg and recently the Isle of Man do sustainability issuance, and I think that's probably kind of more where sovereign thoughts might be if they were drifting away from green in any way. And in fact, I'm just thinking about our own green bond program, which a lot of the allocations goes to, for example, goes to the provision of clean water, which you could say has a social good to it. And indeed the provision of public transport. And, there is a dispersed population in Ireland, and some parts of the country, need that public transport so that people have mobility. So again, you have another social good there, the provision of energy efficiency upgrades to social housing. They're all in our green bond, and to some extent these are about the protection of people. So to some extent you could say, well, we're partly in the sustainability area already, although the bond is very clearly classified as green. So three things popped into my head. I call them the 3 Ps when I saw that question. The first was the idea of penalties for a sovereign in a bond. I don't think that's something we'd be hugely in favor of on first thinking. I don't know how it would be priced in That's the second P. And the third P was really policy, that you would be setting policy in a bond, government policy in a bond offering circular. And I'm not sure that is necessarily a good idea for us to try to promote. But I still think it's a great question, and I could see why we're being asked, and you can never rule it out, but I think that's where my thoughts are initially anyway. So thank you to whoever asked that question.
Bernard?
Yes, I mean, I can fully echo what Mark has already been saying. And I find it also super interesting because I think a similar question was actually raised in the last panel, and I couldn't help but hear the colleague from AIB making very similar comments to what Mark just made. And I think there is a little bit of a question. I think the key question from a policy perspective is, and I think that's actually not from a strategy perspective, let's put it that way, because I think the problem is the same for corporate as it is for sovereign, as it is for quasi-sovereign. You want to have a decent grip on the levers that actually allow you to at least have a decent shot at achieving these targets, or at least kind of having risk management around this, no? Because I mean, otherwise it would be stupid to do this. So therefore, I think if you think about what you have usually decent shots to achieve, it's obviously from an administration perspective, it's your own budget. So I mean, anything that is on kind of your own, the way that you operate as an administration, for example, that's something that you have a decent control over, and you can kind of set targets and you can kind of link yourself to this. But if you think about the kind of higher level, particularly from a EU perspective, if you look at the EU Green Deal or even the Fit for 55, I think there is a significant amount of dependency and codependency on our member states, on our regions, on our cities, on actually the world in a lot of ways. That means that in a way, making penalties, financial penalties, depending on that interdependence, seems a pretty reckless thing to do from a financial management perspective, purely. So I think there we need to simply be rather careful, and I think this is something that we were obviously discussing at the time when we were considering how we wanted to set up our green bond framework. Because I think I fully agree with Mark. It's an excellent question, and it is something that is certainly well worth considering. But I think from a risk management and a financial management perspective, it poses some formidable challenges actually, and I think these need to be taken into account.
No, I think absolutely. I mean, maybe it would be a step down, would be maybe a more interesting option, if you will, into that versus a step up. But just given the financial consequences, and obviously, one of the main reasons the sovereigns have obviously argued this, that it would be a cost saving to the taxpayer. So in a way, it is actually complex if you build these kind of triggers in. And also, just to your part, Bernard, you're so far removed. And I think that's also comes back to AIB's point before. If you're not actually completely in control of the actual data itself, it's hard to link any of the triggers to that data. And so the further you are from the actual activity, and that's why it tends to be more of a corporate instrument. But it is interesting that, we saw 1% last year, and we're seeing 8% already as of year to date of sustainable linked bonds. And obviously the sustainable linked loan market is booming. So again, just, it is here to stay. It's just not everywhere. Now, what I'm going to do actually is, Richard, given your sort of support of issuers as they go into this process, and obviously the pending regulations, the current regulations, and then the voluntary frameworks, I think if we could maybe hear from you how you see those playing together between each other, and then also how you're advising issuers now to incorporate some of the regulations that are coming through solidly with regard to the EU taxonomy and the EU green bond standard.
Yeah, sure. Thanks, Caroline. So I think there's obviously an awful lot of talk on the preceding panel and here and in the market about the green bond standard, taxonomy regulation, etc. But I think the important thing to remember about the EU green bond is that it's intended to set a standard in Europe, and it's a very stringent standard, but it's still voluntary. It's a voluntary framework, just like the ICMA's green bond principles. Issuers can still issue under their existing green bond frameworks and rules if that is what is best for their business. And I think certainly my hope is that the existing frameworks and the existing voluntary rules that are out there that people understand, ICMA, CBI, and others, that people will still be able to issue under those. I think it's very important for people, for the market, not to take a view that if it is not EU green bond, then it is not green, because I don't think that is a fair assessment. EU green bond is great because it is obviously taxonomy aligned, and so there's a very clear legal definition of what is green in the EU taxonomy, and how to report and classify and identify the projects that you're financing. But just because you don't fit into the taxonomy doesn't mean that what you're doing is not green. And I think there's a real risk here that people might get that embedded in their understanding, and I think we need to guard against that, because there are a number of factors why issuers might not want to use the EU green bond standard. So the EU Court of Auditors published a special report there just on Monday about sustainable finance, and in it they kind of went through some of the proposals and legislation that is coming down the tracks, and they particularly called out that there is a risk that voluntary uptake of EU green bond might be hampered by the fact that obviously the taxonomy has been published. There's over 500 pages of legislation set out in the taxonomy, the delegated acts, the green bond standards, and that only covers 2 of the 6 objectives that are set out under the taxonomy. So we've got probably thousands of more pages of regulations to come out over the next couple of years. So trying to, for an issuer, particularly one who, unlike those represented on this panel who have a really good grasp of what's going on, if an issuer is new to the market and is thinking about, will I issue a green bond, to try and wade through not only all of the voluntary frameworks that are available, but now also to try and get their heads around the legislation and the kind of mandatory reporting that's coming down the line with the Corporate Sustainability Reporting Directive, etc. It's a real challenge for them. We also have to bear in mind that, again, one of the things that the Court of Auditors mentioned, which potentially unfair given the amount of work that's involved in trying to do this. I think Eamon on the previous panel said, the financial reporting regime was put in place over decades. We're trying to do it over years. But the Court of Auditors mentioned that the Commission has been slow in proceeding and adopting the proposals that they initially wanted to. I think that, the taxonomy doesn't include agriculture, doesn't include natural gas, doesn't include nuclear energy. We're going to be waiting till probably 2023 until we have the other 4 objectives, the screening criteria for those finalized. So there's a lot of reasons why it will take a long time for EU green bond to bed in, and so I think issuers will be justified in asking the question, do I actually want to go down the EU green bond route, certainly for the next few years until things are bedded in. But in the long term, I think the question about will people have to start implementing and aligning with EU green bond, I think that there is much more of a prospect of certainly EU issuers feeling pressure to do so. Essentially what we're going to have is a kind of competitive market between the different frameworks. So you're going to have to decide, for my business, do I want to issue under EU green bond, or do I want to issue under ICMA green bond principles? And I think it's going to be driven by the investors as to exactly, what framework you should use. But if there are issuers out there who are thinking, well, I'll stick with the ICMA principles because I don't want to have to develop the reporting frameworks, or I don't want to have to try and figure out all the metrics to decide if I'm fully taxonomy aligned, they're not going to get away with that for long, because obviously we're going to have the Sustainable Disclosure Regulation coming down the line. We've got CSDR and the obligation for product producers to start including information about sustainability in the products that they're creating. So I think anyone who has their head in the sand and thinks that they don't have to be aware of the taxonomy and start putting in place metrics, I think they're going to have to take that into account. But I'm hoping that EU Green Bond won't necessarily freeze out or cause a stagnation in the market for the existing principles that are out there. Mark already mentioned that for sovereigns, because they have such a broad range of things that they're doing, it can be difficult for them to do a mapping exercise to decide exactly where their projects are aligned. It's very easy for a business like a utility, a renewables business, or even the likes of a lease plan when they're just raising funds to buy electric vehicles. That's really, really easy. So lease plan issuing an EU Green Bond certainly makes a lot of sense. A sovereign, I think I'd like to think that there should still be the flexibility there for others to make a decision not to go down the EU Green Bond route, where the diktats of their business say that that's the best thing for them. But I suppose in terms of actually setting a standard, I don't think that choosing not to issue under Green Bond, I don't think that's going to mean you don't have to implement the better reporting metrics, etc. I think EU Green Bond is going to raise the bar for what everybody else is requiring in their voluntary standards. And I think one thing that's going to be really interesting, we'll see, obviously EU Green Bond is voluntary, but I think Eamon touched on the last panel about regulatory interventions that could make EU Green Bonds slightly more mandatory. So, there's the idea of the banks are going to have their bank green asset ratio. The ECB is also considering prudential treatment of environmental exposures. If you start seeing requirements for, even under SFDR, the dark green funds, if there is some recognition in EU law that it is easier for them to show compliance with those rules by issuing an EU Green Bond, then, by investing in EU Green Bond, then I think that we could see EU Green Bond taking over the market, certainly in Europe.
Yeah, no, I think that's a very good point, and I think that was actually the reason, in many ways, why the EU taxonomy was actually brought to the forefront anyway. It was more from an investor's perspective than actually from the issuer's perspective, and actually to give some definitions. But Janice, if I could turn it to you, obviously you are in a lot of conversation with investors, and I think that's really a crux of this is, what are the kind of questions that investors are asking you as you start to go down this road with regard to the EU taxonomy and the green bond standard and the integration of that? Because I know also investors are also grappling a little bit how to do that themselves for their portfolios.
Mm-hmm. Yeah, I have to say I haven't had a great deal of conversations with investors where they've really pushed the agenda around the green bond standard. I think on the taxonomy side of things, yes, we've definitely had those conversations, but I think what we've incorporated within our framework and even through our marketing materials and when we were speaking with investors, we are broadly aligned to the green bond standard. Our assets are eligible. As Richard quite rightly points out, we are a monoline business. It's monoline assets that we are looking to issue green bonds on. And of course, there would be work to be done on the do no significant harm side of things. But broadly, there's alignment. The questions really are more around, appetite to do it. Will we expect to do it, etc. But I think given that the market itself has been developing over the last 12 months, for instance, I haven't seen huge push to do it. We actually tend to get more questions at the moment, really around our sustainability strategy generally, our alignment, our own alignment to, for instance, net zero emissions. Are we doing science-based targets? So I've actually seen a maturity in questions more along our strategy than I have seen around a great push towards issuing with respect, in line with the EU Green Bond standard and the taxonomy. I think there's some element of it is that we've already positioned ourselves as being broadly aligned. We've already included within our framework, and we've already made a general statement that we are supportive we will be supportive to the green bond market. We will issue regularly, and we will align ourselves to market best practice. And if that is, as Richard points out, if that is the green bond standard, then yes, that is where we would look to go. But as I said, I see most of our interaction now really pushing around our sustainability strategy and our commitments that we've made. Sort of bringing those two things together. So not just the green bond, but also what the group is doing. I expect that we will get more questions around the standard in the coming, 6 to 12 months. And as I said, that broad alignment that we have, we've already started to include that within our materials, for instance, particularly specific criteria and that to try and already highlight. So I hope that answers your question, but I think it's sort of what I'm seeing is really not a huge push, but more a general interest. And as I said, we may have already addressed some of our questions, or the questions that would be addressed to us via our materials.
You're on mute, Caroline. Caroline, you're on mute.
Caroline, you're muted.
You'd think after 18 months we would finally learn, so forgive me. And Bernard, it was really funny because I was going to turn it to you. Obviously, representing the EU in many ways, kind of getting your view on the EU Green Bond Standard. And unfortunately, we don't have much more time, but I did think it was pertinent to get your response.
I will try to be brief. No, I think Richard has already kind of recalled the most important features. No, the idea is that it should be, and you've already said that it is for investors, the key feature, in the sense that it's voluntary as well as a gold standard. So I think the idea is really that to put a high bar, but not oblige anybody to jump. Now, how this will work in terms of the market, I think is indeed, my personal opinion is a bit that, like what Richard has already outlined, there will be a competition in the market between different frameworks. And I do believe that investors might actually choose certain frameworks over others for reasons that are intrinsic to their own considerations. And indeed, if there was at some point changes in the regulatory environment that would actually give an edge to one or two of these frameworks, to the EU Green Bond Standard, indeed that will have an impact on the outcome of that competition. So I would fully, in a sense, subscribe to what Richard has said, and I think that is in a sense in line with what we would like to see. I would also echo what Janice has said. It is indeed significantly easier for a monoliner than it is for a sovereign, and I think that it simply needs to go for the sovereign like for ourselves. So it is just more challenging for a sovereign, and I think there's no way of talking around that.
Mark, any last thoughts?
Thanks, Caroline. I was worried you'd leave the last word to me on this. Thank you. I listened carefully to everything that's been said, and Richard went through a huge amount of material I was nodding my head to. Look, the standard is voluntary, and we're all aware of that. But of course, sovereigns are nearly always asked to lead by example. But I think this is actually probably a tougher one for sovereigns to lead by example for all the reasons that we set out earlier, the practicalities of it. I mean, if you think of it, look at our impact reporting across 19 different, very diverse programs, about 100 different kind of environmental indicators that flow from that. If the whole of the state was saying to me every year, look, Mark, these are all completely aligned with the taxonomy, well, I'd have nothing to worry about at all, and we would just jump in. But the reality is that the standard is so detailed and technical, and it still has gaps, as Richard clearly outlined. That would need to be knitted into the state's reporting system. It would need to flow right from the procurement stage to the delivery stage, right? It would have to be very, very clean. And from my perspective, I see that as being a longer term ambition. It is a gold standard, as Bernard has said, and to some extent, it may be too gold, maybe aiming for perfection when good might be a better place to start. So look, we're very positive on it, but I think it has some some work to do, particularly from our perspective. So that's where I leave it, Caroline. Thanks.
Super, thank you. I think we can't really describe it as anything else. This is an evolution, and we're all sort of on that journey. And I think we'll have many, many more discussions on this topic. So on that note, a huge thank you for your time and all the insightful comments. And if I could maybe pass it back to Mark for the closing comments. Thank you.
Okay, thanks very much, Caroline, and the rest of the panel. So I won't delay. I'm sure you're all looking to get back to your day jobs or finish for the afternoon. Just thanks to everyone, to Nicholas, Paul, Amy, Caroline as moderators, to all our panelists. I'd like to thank you, delegates, for attending the webinar. I hope you found it interesting. Certainly looking at the number of delegates who've registered, interest levels went way beyond Ireland and the local audience. So again, appreciate you joining us. Thanks for your questions. They were useful, insightful, and certainly helped the conversation. Closing remarks really are just to remind or highlight to everyone the role that ICMA plays as a deep resource base in addressing and considering all ESG related matters. For example, today there was an updated publication on sustainability disclosure within the EU, a topic that took up a lot of the conversation earlier on today. ICMA, I would anticipate, will continue to provide leadership in the ESG debt capital markets, and will continue to sort of be a sort of a bedrock criteria that issuers will look to continue to adhere to, notwithstanding other regulatory developments and green bond standards. So with that, I'll bring the webinar to a close, and just a final word of thanks to Ravina Patel and the ICMA events team who organised all of this. So really appreciate their efforts. So other than that, goodbye. Wish you the best.